That's ISO.
Welcome to the channel. My name's Jodie Knight and I'm a popular investor over on eToro. You can find a link to my live portfolio there in the description below, as well as a link to my website at www.thecraftytrader.com. On there you'll find all of my deep research to my core holdings and my strategies and stuff like that. Quite helpful for new traders. As usual in this video, we're going to take a look at the macro data Monday to Friday. Wednesday and Friday are probably where most of the action is. I'm guessing probably everyone's had a bit of a rough week on their portfolio given the market breadth and the pullback. And we'll talk a little bit about that, and then we'll have a look at the standard stuff that we normally take a pick at, like the dollar and oil and stuff like that. We'll also take a little look at a swing trade that I'm setting up based on the QQQ and have a little chat about why. Jumping straight into Monday's data, nothing really too exciting happening. I don't really pay too much attention to the manufacturing, but it has pulled back quite a bit. Not ideal, but again, it's in contraction quite a lot of the time if you take a quick look at this. So we're hardly breaking trend here. Tuesday then, red book, pretty much within tolerances as well. Housing data market continues to ignore that while it's all locked up. We did get the services data as well, which I actually quite like. I like that the services revenues were improving, higher than expectation. The Fed Services Index was lower than expectation. Take a quick look here. But when we look at the big picture, it's a much better improvement. The other data we got on the Tuesday were the JOLTS. The job openings, more available than forecast. So in one regard, that's kind of good. Kind of neutral, really. It's not hugely different. But the job quits, interesting that was actually lower than forecast. So what do we know from that? Well, that tells us that people don't want to leave their jobs quite so much at the moment, suggesting people are comfortable and they don't want to shake things up while they know some turbulence is coming. So we don't really like to see that one come down too much. So if we look, it's been in quite a consistent downtrend. It's definitely a warning flag there. But I mean, can't say it's a surprise. It's been coming for a while, although it has fallen off a cliff recently. The only other data to look at for the Tuesday was the consumer confidence. Interestingly enough, it's up slightly, which, given what we're hearing in the earnings calls, is a bit strange. So I'm wary of that one a little bit. Wednesday was quite a big day for the market, but primarily because we had the Fed rate decision, but that was really late in the day, so not much exciting out in the morning. More home data that's being promptly ignored. I do like to take a look at the ADP employment change. That's come down quite a lot, definitely lower than forecast. So even before Friday, we were getting some warning bells about the jobs market numbers. They've been going for some time now, as you can see in this downtrend, but definitely a sharp drop this month. And then the rest of the employment data came in fairly in line, nothing too alarming there. More home data. But then the big exciting party, Fed interest rate decision. I mean, I don't think anyone was shocked that it was a pause, but given the data that came out on the Thursday and Friday, I think there's a lot of panic now that it was a pause. So I guess the market should be careful what it wishes for. I think all the panic's a little bit premature. Yes, there's been an acceleration in the degrading data, but it's only one data point still. I guess technically the rest of the data is also degrading, and I think a lot of the fear is coming as well. People thinking the big boys are doing terrible. Earnings season's actually been okay. It's not been too bad. The problem is that a lot of the mega caps and the large companies, the price has got so extended that it just needs to come down to earth a little bit, which I actually don't think is too far off from doing so, but we'll talk about that later. I didn't listen to the Fed conference live. I was busy living life. We've had some lovely weather here in the UK, so I've been enjoying that and also juggling that around the earnings calls for PayPal and so far. So I've been dealing with that. But as far as I can tell, the commentary was mostly dovish and the market did respond very nicely to this initially. But moving on to Thursday, we get the ball rolling with the Challenger job cuts on this one. Let's take a quick look in this one. You can see the US employers announced less job cuts. I think this is because last earnings season there was a lot of job cuts coming out. You only had to listen to a few earnings calls to hear just how aggressive the cuts were going to be. Mainly that I think was in tech. I think the companies just got so bloated and they just ramped up so hard that they really needed to streamline their businesses. And that's been quite a contributory factor to how well they've done. Um, but obviously, if they're not going to cut as much, that also adds to a lot of the expectation of more weakness coming forward in the next earnings season. We've seen that a lot with guidance not necessarily being lifted, but it's kind of holding steady. So it's definitely something to keep an eye on this one. There are companies out there that still have room to cut. I think PayPal should definitely cut more. But I think the rest of the big tech probably running quite lean at the moment. The rest of Thursday's day, we've got initial jobless claims that came in higher, continuing jobless claims came in higher again, and the average came in a little bit higher. So we're seeing more people leaving the workforce and then not being able to get back into it, which is a worrying trend. And if we look at the continuing jobless claims, this has been grinding higher. This has been a red flag for a while. It did flatten out a little bit, but the fact that we didn't come back down a bit is the worrying part. And then we've started to move back higher again. So we don't like that. We've not liked that for a while. What else did we have? The manufacturing PMI again. I'm not super interested in the manufacturing numbers, but came a little bit higher than expectation. Manufacturing PMI a bit lower than expectation. But if we look at this and we zoom out a little bit, it's within, I would say, tolerances. I don't expect manufacturing to be a key thing for US for some time. They pretty much outsource most of that now, as do the UK. So then it's more of a Western thing, I think. What else do we have? Construction spend. Don't like to see that coming down too much though. So not ideal that it's in contraction again. New orders a little bit lower. So weakness in nearly everything at the moment. The only thing I did like was the Fed balance sheet. They continue to run it off. That tells me that the Fed have got some confidence still that they're not having to support the economy just yet. Could see that change next month though. Finally, Friday, this non-farm payroll was a bit of a disaster. If we take a look at the actual numbers here, quite an aggressive downtrend. Back when we had this initial drop, I thought maybe this is a red herring. Maybe we'll come back straight up. I mean, we did come back quite considerably, but we've continued to come back down on pace to this. So maybe it wasn't so much a red herring as a really big, bright warning flag that we probably should have paid more attention to at the time. However, the main thing I don't like about this data are the super large revisions we've been getting on it. Bear in mind, this number's already quite low at 114. If we get another revision on this, it's putting us even lower. And then if next month comes in lower, we really run the danger of getting into contraction here, and we do not like that. The market would not like that. So hopefully this can be staved off a little bit. The other employment data that we got on the Friday was the unemployment rate. Now, when we got the 4.1% rate last time on previous, all I could think was it's definitely not going to stay on that. And there was hardly no reaction to us going over the 4% Fed target. So the fact that everyone's pooped themselves now is a bit silly. It should have been obvious that this was coming, given the rate in which the jobs numbers were still sliding. And I think for the most part, some of these numbers have been massaged to look better than they actually are. Some of them have been quite fishy, especially with the government numbers trying to bolster things. But I don't like it. I think we're now getting to a point where a soft landing's unlikely. Initially, that's what I really wanted, but I think the Fed cuts needed to be a bit more proactive than that. I think by the time the next meeting comes around, rate cuts are probably going to be considered more reactive, which isn't ideal. But I think if we do, well, probably I think the consumer is in a bit of recession already, but if we do get a broader recession, I think it's going to be short and shallow. The main reason is the liquidity coming to the market. The Fed has a lot of room to put in some expansionary measures. They could obviously stop the balance sheet runoff. They could bolster the balance sheet, or they could cut rates aggressively. There's a lot of scope for rates to fall, and that will encourage the economy to grow. So I don't think there's any real worry of a deep cutting recession. So for that reason, any dips we get, I'm going to be buying very aggressively. I might actually make my monthly deposits larger if this downtrend continues, just so I can really capture that. But again, we've got quite a long wait till the next deposit, so I'm just going to have to jiggle stuff around and find where the bigger opportunity is, because those are the things that I really want to rotate into now. Moving on to a couple of charts here, we'll start with oil. We did break down very nicely underneath this Fibonacci level. Now that's going to turn into quite nice resistance, as well as it's got this confluence with the pennant wedge, whatever you want to call it, triangle pattern. And no point in giving it complicated names. It's not voodoo. And it has come down nicely to this fib and bottom of the trend confluence here. Love it. Love that it's bouncing there after a nice drop. I do think it's going to chop around quite a bit in this area, likely as the macro shakes out. We're getting a lot of conflicting signals from all over the place, but my expectation would be that this does break to the downside. I don't want to jinx it too much, so touch some wood. But yeah, I'd like to see it bounce around here a little bit, get to the pinnacle or peak or tip or whatever you want to call it, and continue to break down back down to this $67 range. I'd like to see it stay here. That's really going to help inflation and help the markets move. Moving on then to the dollar, same situation really. Broken a key level that it needed to hold, and now it's turned that into resistance. It's now at this support level here. It didn't have too much of a wick down, so this gives me a bit of a bearish tilt. So next level below that would be this $102. So I'd like to see that continue to the downside, but even if it did bounce, I'm happy with the trend of this is still back down. Eventually I'd like to see it get back down to this $100 level, but time will tell. As usual, take a quick look at the data that concerns us the most, which is the cost of freight, containerized freight. It has come down a little bit, so it's nice to see that it's not progressing, but again, I'd like to see this come down more. It is getting into the peak season, so we'll see how this goes. Definitely still keeping an eye on this one week to week. On to commodities, we can see lithium's down again this week, -7%. So it's been really liking this down 70% level year over year. So I really like that. Tesla's going to continue to benefit from that. And it's important for me to track that one, given that that's one of my core positions. Although a lot of people throwing sticks at me about it, but what can you do? Moving on to agriculture, obviously this drives inflation for a lot of goods. For the most part, weekly is relatively down or flat. The outlier really being butter, that's up a little smidgen, so not too concerned about that one. Moving on to interest rate probabilities. I know this is what everyone's really excited about. We're starting to see the increased likelihood of 50 bips. So I think that will rise. If we get more bad data, we'll see this number rise. But I think the chances of not having a cut at the next meeting are 0, and that's what the market's pricing in. There's a lot of people saying it's too late, but if things did get really bad, the Fed could cut in an emergency meeting. I don't think it's at that level yet. I think they know they've got a lot of tools at their disposal that they can boost the economy with. So I wouldn't expect them to give us an emergency cut. I think they'll just wait and give us either a larger cut if it warrants it, but we'll see how the data goes from now until then. And then, I mean, the chances, it's getting really promising that cuts are coming, and that's why I've configured my portfolio the way it is. Quick look at Truflation. It's ticked up a little bit, but still way under the Fed's 2% limit. Again, I talk about this on my website a lot, so feel free to follow any of the links there. Fear and Greed Index, don't like to talk too much about this one because these are all over all the forums and discords and stuff all the time. The market's now in fear. It's very healthy for us to get into fear. I would actually like it if we tapped into extreme fear for a little bit, really cooled things off a little. Crypto, again, that's in greed, no surprise. We've gone relatively risk off, and then there's all the worry about countries selling. So I'm buying still. I might actually get more aggressive with my buying if it drops even further. I don't have too much exciting bonus data today. We talked a lot about all the jobs numbers we've been getting and what that means for the economy and where I see things going. So I thought I'd just put in something relatively bright. Don't know what the word would be to discuss it. Positive's probably a better descriptor. Basically, the tech industries really had some heavy pullbacks, and I don't want to specifically buy any of the big stocks like Microsoft, although I am quite tempted to add Microsoft. It's looking pretty good, or Meta and stuff like that. Predominantly, my reasoning is my pension fund is quite large, and a lot of that is invested into these companies already. So my pension's taken a hit this week. Um, so yeah, but I do like the TQQQ, which is the leveraged version of this. I'm not sure if you can see it too well on there, but it's had a large pullback. I did initially add on this chop above the bull market band a small position. Since then, we've fallen back to this support band at the Fibonacci level, so I've added more. Now, if we continue to fall, I'm going to get more and more aggressive with my purchases on this one. My take profits. This is just a swing trade. It's not going to be a long term hold. I don't really want to hold this super long. But my initial target will be the 52-week high, which is this peak here. And you can't see it on this chart, but there is another high that's slightly higher. That will be 25% of my position closed at that. So that'll be when we go blue sky. And then the rest of it will just be closed into weakness. I think I do point out on my website that it does look like a very nice cup and handle when you look at the shape of it. If this comes up, the measured move for it is quite monstrous. So that's probably going to feed a lot of bulls. And I imagine that when we do come to break over this level, things are going to get even more bullish. So, but I think I'll be well out before that run anyway. Probably 50-60% gain, but not bad for a swing. So I'm sizing into this one as we speak. But I'm happy for it to continue to fall. I do like buying these ETFs indexes when things are down, just for swings. That's pretty much it. I've updated my portfolio tracker for the week for most of my accounts. It's bullet across the board, as I'm sure you all probably are suffering with as well. As well, on the website, I updated the Q2 earnings for Tesla, SoFi, and PayPal with my thoughts on them. Has my thesis changed? Short answer, I'm still bullish as heck on all of those companies. If anything, I'm more bullish on PayPal and SoFi and Tesla. So, spoiler alert there. I have successfully managed to upload charts 2 weeks in a row for all of my core positions. So they're on YouTube. Feel free to follow me there for more content. Other than that, I just put a little pre-warning here. I am on holiday, not this week, but the week after, from Thursday. At least I think it's the week after. I'm going to have to check. I'm a bit rubbish with dates, so I'll check with my partner. But I'm debating if I'm taking my laptop or not. I might take it and just whack out the daily videos really quickly, but I probably won't be updating stuff on the website or too live on eToro, as it's a really big family holiday. So I'll keep you guys updated with what's happening with that. Other than that, that's it. That's a wrap. If you like this video, give me a like, a share, and subscribe to my channel, and I'll hopefully keep bringing you this content.